Hi, I'm Peter Rose, founder of Longwood Currency Trading. How I pulled a $5,000 profit from a massively negative position. That is the topic today. And it's a beautiful fall day in New England, mid-October of 2023. And I just I'm appreciating the beauty of the fall because I made the 5,000 and recovered from this massive loss. It was 15,000 running losses. You say, "Oh my God, Peter, how can you have a $15,000 running loss?" Well, you're trading with big lots. That's how you're doing it, and you have to trade aggressively. If you're trading for big lots and managing that account, you're moving toward a substantial profit target. That's what you're looking for. And so because you're looking for maybe a little bit more extended number of pips in order to really maximize the value of that trade, because the belief is you don't put a trade on that big unless you think that the momentum is really there in order to get the price to where it's supposed to go, then you have to be trading with a large enough account that you're able to manipulate these lots and things as you go through. So that's the justification for the massive size. Well, Peter, how did you get yourself in such a jam that you had a $15,000 negative position? Where was your fucking stop? When you're a day trader, and trying to get in and out and hold and be flat at the end of the day, you're not blocking your view with limit orders or stops or any of that stuff. You're trading. Do I suggest this for beginners? No, but beginners don't listen to my channel because I talk about advanced topics, because I'm specifically working with folks that have five-figure accounts and just aren't having the success that they need to have. And having a five-figure account, when you lose a significant amount of money, and you need to stop the bleeding. That's where I can help you out. Anybody can teach you what a pip is and how to run things and all that stuff. Now, whether they can marshal their educational process in order to teach you actually what to do with all that stuff that they're teaching you is well, as I've said in many of my videos, I think it's sorely lacking. It's something you have to be very careful for. So the stuff that I talk about, particularly in this video, isn't something for the faint of heart, that's for sure. When the envelope opens up and you say, wow, there's nothing but open air between where I'm at and where a potential profit target is, and you're at the right time of the day with the right currency pair under the right economic conditions and the right past price action, and you're ready to go, and so you drop a couple of lots in and you're standing there and you're managing that position. So what happened to me then? I went in as a normal, I throw a couple of lots in, bing, it goes off. Price moves a little bit in my favor. I add to it a little bit. Goes against me. Goes against me to negative. I'm thinking, well, this is normal. I'll let it go a little bit more than my normal 10 pips. We'll see what happens. Maybe it's going to be a regression to the mean event, or maybe there's some candle formations or patterns that appear to be causing price to congest in a certain area that it's gone above. It doesn't look like it's going to break through it, so it'll turn around and come back. And so you add to it in a negative sense, which is all fine, not for a beginner, but you do that. Then the thing starts coming back in your favor. Maybe there's a news announcement or something, and price is going really quick. It bangs off another couple of your orders, and you're feeling really good, so you're ready to go. And then all of a sudden, boom, you get whacked. Price moves totally in the opposite direction. Not only does it move that way, but you get caught such that your major parts of your position now on, for example, a 1 hour chart now becomes a pin bar. And you're at the bad end of the pin bar, and price is at the other end, at the body. No stop, big loss. How far are you going to let that go? It becomes very difficult when you're trading with 6 or 7 or 8 lots to say, oh my God, if I cut the trade at this point, I'd lose $3,000, $4,000, $5,000. We'll just let it go and see what happens. Because when you're in that deep and you're convicted about where you think that price is going to go, you don't abandon your position. You don't lose your position, as Jesse Livermore said. I don't want to lose my position, because when it turns around, it'll be okay. Sometimes it isn't okay. A lot of times you can get away with it. Sometimes you can't get away with it. I lost $100,000 on a trade one time because it got away from me. You have to determine what's too much, okay, in order to make sure that your bank as a whole is not jeopardized by going into a negative balance for the amount of money that you've put into it. We're all trading with borrowed profits. They don't become profits until we say, okay, I'm not going to take any more risks. I'm going to go back to just grinding things out. The volatility is all done with, so I'm going to go back and I'm going to grind through this stuff, and I'm going to make $300, $800 a day, whatever it is that your bank size is able to get you through, and you put it out of your mind that a $2,000 day is not going to be in the realm of things for the size of the bank that you have. And so you're just grinding away until, again, you get one of these coalesces of factors that put you in a situation where you're in pretty heavy, and boom, you get a surprise. It goes against you. The stop wasn't there, so you just went, price just went through, and you're sitting there with your pants down. What do? Well, you can close out, which that's not a bad thing to do. Taking a $5,000 loss is better than letting it go to $20,000. But you do become convicted with this stuff. That's why it's not a beginner thing. You have to know, to some degree, or have confidence in two things. Number one, your ability to judge the reality of your initial entry analysis. And the other is you have to have the staying power, you have to have the bank in order to withstand these large, these large losses, and be able to ride with them, and making sure that the losses don't exceed maybe the month's profits. Maybe you're up $4,000 for the month, and so you don't want to take more than a $4,000 loss, because that would wipe out the month. So maybe you take a $2,000 risk, or you let it go $2,000, and they, oh, that's too much, and okay, I'm out. So you want to preserve things. The particular position that I was in at this time is I had made $35,000 the month before, and I was up $10,000 so far in the month where I'm at. And so I'm looking at this thing at the $5,000, $8,000 loss point, and I'm going, okay, I'm gonna stand through this. Actually, it was around $8,000. I'm gonna stand through this. I'm gonna hold, because I've got what for my size bank, what's reasonable for me to make on a monthly basis. I know what my numbers are. I know what I'm generally capable of doing, which also tells me if I lose some amount of money, how many days will it take for me to make that money back? How many days am I losing? If I'm only losing 3 days profits, okay, fine, I can get back in, and maybe I'll hit one on a roll and make that up. You do that many times, particularly when you're trading large lot size, and your loss on a normal basis could be $800 to $3,000. You say, okay, I lost $3,000, but I normally make $1,500 a day, or when I trade, okay, I'm looking at maybe 3 days to get my money back, to break even. So you're basically losing 6 days, okay? So of your trading, so you balance that as far as where you want to see your negative balance of your bank to be. I was in a fortunate position that I'd gone through some lucky days of volatility. My average daily take when I was trading, I was trading about every other day. I was getting a good position in through the month. I think there's 20 trading days in a month. I think out of 13 of those 20 trading days that I traded, my average was about $2,600 a day. So I'm feeling that when I'm following my rules and doing the right shit, I can probably figure on $2,000 to $2,500 in makeup time. So I'm $8,000 behind. So that's, you know, 2,500 into 8, whatever that is, 2 days, 2.5 days, basically of trading in order to make that back. So I was willing to let that side considerably more just based on that, as well as the fact that I had 13 days of really good profits, 35,000, 34,800 the month before, and 10,000 this month. So I'm $40,000 up on the game, and in a month and a half. So I'm way ahead as far as money that I have that I can put at risk. So I sat there. In fact, I let it go overnight. And it's really dangerous when you let things go overnight, because the price keeps going against you. Sometimes it turns around. You get the one currency pair to open, in the middle of the night, and then your country opens in the day, and so you get 2 flash periods, and sometimes things will come back pretty good. So I get up the next day, and I'm 15 down. This is not good. This has got to turn. Part of the analysis is looking at 3 15-minute bars of probably 30 pips each. So is that sustainable? No, it's not sustainable. It could be sustainable, and we've certainly seen that. We've seen pricing move in a few hours several hundred pips. So you have to be realistic about how far you're going to let this thing go. But I'm 15,000 behind on an open position, and it's heavy. I'm looking for signs. I'm looking for marks in the price action. And you really have to, this is where you have to know how to trade. You can't just be following somebody's system. You have to know how to trade. I began to sense a change in the market. I added to my position. The position started to move in my favor. I added to it again. It went against me. I'm at 20,000 now because I've added. It starts to come back. It's coming back pretty good. I go all in. I'm at the point where I'm trading at $200 a pip, and I don't want to push it any further than that because I'm already in that $15,000, $20,000 negative position. So at $200 a pip, it doesn't take a whole lot of more pips to go, ouch. Okay, so I got to sit with that overnight again. I get up in the morning. Price has turned around during the opening of I'm on the East Coast of the United States, so the European Open goes at 2:30 in the morning. I'm up at 7 looking at the price action, waiting for the 7:30 U.S. session to open. Prices moved 200 pips in my favor, It's hit two more of my stops to add to the position. It hit the third movement, which brought my average position value way down to or much closer to where my current price was, and then price just started moving again. Then it hit a little bit of a chatter, and I went, I'm out. And I took a $5,000 gain from what was a $20,000 running loss at a certain point, because at that point where I began to sense that things were turning, that was where it turned. Do I get that right every time? No, that's why you don't want to do this every time. And I've been looking at the currency market since 2007 and the general financial markets since the mid-1970s. So I've been around this stuff a lot. I also did 40 years of real estate investment. And that's more of a problem for me than it is from a risk management standpoint than anything. However, the thrust of the video is that if you are trading with a large enough lot size, and that you're not trading at 200 to 1 leverage, but you're trading at reasonable leverage, and I trade 10 to 1, I'm sorry if you don't feel that that's going to get you rich and taking $3,000 to $300,000 in 18 days, I'm sorry. Good luck to you if you're pushing your luck like that. But it isn't that I'm trading slowly, I'm trading carefully under risk management. That gives me the ability to build up a good profit margin in the overall trading over several months period of time, so that when I swing for the fence, maybe I miss. Maybe one time I'll lose $10,000 or $15,000, and I got to try to make that. I got to try to make that back, and sometimes I do. Sometimes I'll have that 15, like I just had this thing at this $15,000 position. I get it right. Ultimately, it goes to where my profit target was, where I thought it should be, and turned around. I add to the position. I manage the position. That's the second phase of the life cycle of a currency pair. That's a term that I have applied to that from my 33-year career as a software engineer. The life cycle of a currency position is entry analysis, position management, and exit methodology. And so I'm in this position management phase, and I'm managing that position so that I bring my average cost more in line with where the current price is, so I don't need so many pips in order to get something out of the trade. So I'm trading at a 20 full lot position, and I make $5,000. So at $200 a pip, how many times to get $5,000? Not many, not that many pips. $5,000 in relationship to a 10 to 1 trading ratio, $200,000 account, let's say, 5,000 divided by 200,000 is not a real big return from a percentage standpoint against risk. It might be a, I don't know, 5%, 3%, and 0.5%, 0.3% return against that size of a bank, which is not really good. I mean, if you sustain that 0.3% over every day for the year, you'll be fine. But when you are trading large lot size positions, the dynamics of all those metrics and their calculations change radically. And so it isn't so much that, oh, geez, I only made 0.3% on that with that $5,000. I made $5,000 fucking dollars. Okay, so it stops being a function of percentage, and it becomes one of dollars gained. $5,000 is a lot of money. There's a lot of people who don't make $5,000 a month. There's a lot of people who don't make $2,000 a month. So we all have to be realistic about what we're dealing with, but we can't be in so much fear. If you're going to trade currencies, You can't be so much in fear of loss that it blinds you from the ability to get the gain that you're looking for, and not to do it stupidly at 200 to 1 either, because anybody that's trading at 200 to 1 is going to wipe their account. These guys that trade at 200 to 1 only trade a small account because they're looking for the big run, but they're taking big risks and losses for the most part. So that's why you'll see maybe someone, I won't mention any names, but they'll trade, they have hundreds and hundreds of thousands of dollars available to them to trade, but they trade a $30,000 account because they're going to blow that account 3 or 4 or 5 times. And then when they finally get the position to go right, that $30,000 account goes to 300,000 or 400,000. That's what you can do. So you take 4 $30,000 losses, you're down $120,000, then you make $400,000 or $600,000, then you can make up for a lot of those losses. It all has to do with your risk management, and the metric that we use for the success of that risk management is the win to loss ratio that I talk extensively about. And so if you are dealing with smaller position sizes, low 5-figure accounts, you're not staging accounts, you're not building positions, you better still be going all in, all out. Don't be trying to compound, don't be trying to stage, be very conservative with what you're doing as an all in, all out trader, because that'll build the metrics that you need to build. Once you get up into the larger lot size, those metrics don't make any sense anymore. The win-to-loss ratio ceases to be on a transactional basis, and it moves up into, oh, this is what I did on a daily basis. To give you an example, on a daily basis, my win-to-loss ratio is about 82%. So I'm winning about, I'm sorry, it's more than that. It's about 90%. I just calculated the other day. So if I take 10 trades, I'm going to win 9 of them, and I'm just going to lose 1 on on a daily basis. I'll win 9 days. I'll come away with a profit 9 days, and 1 losing day in that 10-day period of time. So I've got a 90%, a 90-10 win-to-loss daily ratio. But because I'm building positions and staging lots in and all of this kind of stuff, my actual transaction win-to-loss ratio becomes 61% wins and 39% losses. So it radically changes that ratio, but it still helps you determine how you're going to manage your positions and manage your risk, whether that be on a position basis or whether that be on a daily type basis. Regardless of all that, the thrust of the video is, if you start trading in large lot sizes, you may find yourself at the deep end of the pool and really struggling. Do not panic, because if you've got to the large lot size by following rules, solid rules, and you're consistently successful, and you know how to judge your portfolio against the risk that you're taking, then you can continue to hold some of these positions for a longer period of time, because you know you'll be able to work the position. You understand how to trade. Position management, when I'm working with someone, the first thing we have to do is that entry analysis, because if you can't get your entry right, you're not going to have a position to manage. But once you start getting your entry right and you're having consistent profits, the only way that you're going to be able to extend those profits and make really big money is if you understand position management. The entry analysis has nothing to do with making a ton of money. It just enables you not to get stopped out or to do stupid shit. But once you are able to do that, you better have somebody that's showing you how to do position management the correct way, or your exit methodology is going to be negative all the way through. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.